Hi investors, today we are going to discuss about a new fund offering which is SBI Dynamic Asset Allocation Active Fund of Funds. But before we start the video, let me introduce myself. I am MD Imtiaz Ala, a NISM certified and an AMFI registered mutual fund distributor and an IRDA licensed insurance advisor. So let's start. So presenting to you SBI Dynamic Asset Allocation Fund of Funds. The tagline is tuning the dial of opportunity, dynamic allocation for potential growth and stability. So it is a new fund offering and the offering dates are from 25th August to 8th September 2025. So let me first introduce it that this fund is for whom? It is suitable for long-term capital appreciation and the investments in units is actively managed in equity and debt-oriented mutual fund scheme. It is a hybrid fund, so it will be suitable for someone who is wanting to invest money in the mutual fund industry for, let's say, more than 3 years but less than 5 years. So now let us discuss why do we need asset allocation, or why is it necessary to have a good asset balancing between different categories. So the thing is behavior gap. You see, the average investor underperforms the market over long periods of time by a wide margin. So why is it that? Because Carl Richards refers to this as behavior gap, which is the difference between the higher investment returns investors can possibly earn versus the lower returns they earn due to their emotional behavior in responding to whatever is happening in the markets, volatility being the leading culprit. So investors can definitely earn good returns in the stock market, but this does not happen because of our emotional behavior, which is because of the volatility in the markets. So what is the solution to the problem? Main solution to that problem is diversification. So we need to combine different asset classes to get a good risk reward ratio. And the thing is, we also need to have asset class timing. So we need to know that which asset is good in which time. Asset allocation is responsible for significant part of the potential portfolio returns as proved by numerous studies. So there has been numerous studies which suggests that we should have good different asset classes as well as the timing should be great. So what is the solution to that? It is a hybrid portfolio, a multi-asset portfolio with significantly better risk return characteristics than traditional products. So traditional product here refers to stock market, normal investments and equity funds or all that, whatever you could say. Winners keep rotating between asset classes. So if you see that who won in the stock market in the last 25 years or whatever, so you would see that in most of the cases, in some years equity performed better, in some years the debt performed better. So if you see here that in 2015, BSE 500 try, it got a negative 39% returns. Sorry, it got a negative 3% returns. The Kaisil bond index, if you see, it got a positive 9% returns. And if you see the Nifty 50 try, so it only got 0% returns in 2025. But if you see in the second year 2016, okay, this year also the bond market performed proper. But in 2017, the Nifty 50 gave you a whooping 38% returns. And whereas the BSE 500 gave you 30% return, but the bond market was very down, it gave you just 5% return. So it happens like that in some cases bond performs proper, in other cases the Nifty markets or the equity markets give you great returns. So what does it tries to tell you? Prominent equity allocation is essential for wealth creation, albeit effective asset allocation plays a vital role in successfully navigating market cycles. So in the stock market, there are cycles where in some time the equity performs good, and the other times the bond market performs good. So you need to have both the things in your portfolio. Each asset class has a different return profile. So if you see the rolling returns, if 1 year rolling return we compare, we see that minimum there was a drawdown of 9.8% and maximum there was an upside of 28%. Average you got something like 6.5%. And if we see, this was for debt. And if we see for equity, there was a drawdown of maximum 56.5% and there was an upside of 112% and average we got 19%, close to 19% returns. If we see the 3-year rolling returns, there was a downside of, in the debt sector, there was a downside of 1.8% and upside of 13%. But if we see in the equity segment, there was a drawdown of negative 7.7% and upside of 65.4%, and average we got something close to 16.9% returns. So we see here that in equity we have a higher risk and a higher reward, and in debt we have a lower risk and lower reward. We need to stay somewhere in the middle to get an ample return. Returns within asset classes and across asset classes have a wide range. So there is a wide range. So why do we need to invest here? Diversification across asset classes helps in building a balanced portfolio. So if we see last 20 years period from July 2005 to July 2025, in the returns of equity sector, average, if we take like 100% equity, there was a return of 14.05%. If it was your portfolio was 100% debt, there would be a return of 7.28 to 8%. If your, let's say your asset class, or you had a hybrid fund which had 65% equity and 35% debt, you would get an average return of 12.40%. If 50% equity and 50% debt, 11.45% returns, and if 65% debt and 35% equity, you would get close to 10.35% returns. But let's say that why are we comparing different asset classes? In here we can clearly see that equity has the maximum return 14.05%. Then why are we talking about the balanced portfolio or the hybrid portfolio? So you need to notice here, it is because of the maximum drawdown. In equity you would see we had a maximum drawdown in a year like 60.33%. So it was maximum drawdown. In debt there was only 9.0%. In equity, 65% equity and 35% debt, there was a 42% drawdown. In 50% equity plus 50% debt, there was a 34% drawdown, and in 65% debt and 35% equity, there was 24.9% drawdown. So now we need to find out that what should be our asset class composition so that we get maximum returns and lowest drawdown. So let's see here. Each asset class has its unique characteristics and risk reward parameters. Investing in a mix of different asset classes have lower correlation, helps in building balanced portfolio, having improved risk reward. So we need to have a mix of all this portfolio. Now you see here, within an asset class as well as performance varies across segments. So if we talk about the equity segment, then also there is a variation of all the performance. In 2012, if we see, the mid-cap sector performed best. So it gave us somewhere close to 40.39%. In 2013, the large cap gave you the best returns. It was somewhere close to 7.56%. In 2014, small cap gave you the best returns. It was 71%. In 2015, again the mid caps. 2016, again mid caps. In 2017, small caps. 2018 and 2019, large caps performed good because all the other sectors or all the other market capitalization gave you negative returns. In 2020 and 2021, small cap gave you the best returns. 2022, again the large caps. 2023 and 2024, small caps were the king, and in 2025, again till now, the large caps are giving you good returns, or I could say that large caps are giving you positive returns because mid caps and small caps are in negative. Now again, there comes another segment, that is the style of the stocks. So if you see in 2012, the momentum stocks gave you the great returns or good returns. In 2013, the quality stocks, that stocks had quality, gave you good returns. In 2014, again the value came because the value stocks gave you good returns. So there are, in different times or different time periods, different asset classes are, in sometimes the same asset class has different market capitalizations which give you different returns. Diversification and dynamic allocation within an asset class is as crucial as investing in different asset classes to build a strong portfolio that can navigate cycles effectively. So we need to diversify and dynamically allocate our assets so that we get a strong portfolio that can navigate cycles effectively. So in market there are cycles. Sometimes it's bullish, sometimes it's bearish. Within an asset class as well, performance varies across segments. So if we talk about one asset class, let's say equity. So there are different segments which gives you different returns. So if we talk about cyclical segments, so in consumer discretionary, it was close to negative 1.9% returns. The financial services gave you negative 8.6% returns. In 2014, financial services gave you good returns. 2015 consumer discretionary, 2016 financial services, 2017 consumer discretionary, 2018 none of them gave you good returns. It was financial services who was in positive. So it depends. And if we talk about defensive sectors, that in which sector the drawdown or the movement is not that much, here we see most of the times it was the information technology that gave you good returns. Healthcare also gave you good returns, but non-cyclical consumer sectors gave you normal returns. It would not be said good or bad, of course. And then we have bonds or debt sectors. So you see here also in corporate bonds versus 10-year government securities, sometimes corporate bonds give you good returns, sometimes it was the 10-year government securities. So you need to have an allocation of all the assets to get an ample return and optimal portfolio growth. Thus the need for asset allocation. Why do we need asset allocation? At first, the first point is risk management. An optimal mix of different asset classes offers better risk-adjusted returns, which can result in lower drawdowns in times of market downturns. Everybody of us wants to get good returns. So we invest in high risk categories, but we don't think about the drawdowns. See, market has a bullish side and then market has a bearish side. So we need to think of all the sides what could happen to our portfolio. So if we have a good optimal mix of all the asset classes, then in the times of drawdown or in the times of bearish markets, our portfolio would have a lower drawdown compared to a high risk portfolio. Next point, dynamic asset allocation. Asset allocation modifications based on changing market cycles can be a source of alpha generation. So if we have a dynamic asset allocation in our portfolio, then we could get good returns compared to that time of the market cycle. And the next point or the last point is diversification. Investing across asset classes having lower correlations such as equity and debt can offer steady returns over a long period of time. So if we talk about a long period of time, then we can get steady returns, not high, not low, but it could be steady and we would not be negative. Most importantly, presenting SBI Dynamic Asset Allocation Fund of Funds. So at first we need to understand what is dynamic asset allocation fund of funds. Dynamic asset allocation fund of funds are like smart investment dial. Just as in a dial you can adjust its settings based on changing conditions like temperature. Think of these FOFs fine tuning their allocation between equity and debt depending on market signals. So what does this type of funds do? They fine tune your asset allocation between equity and debt depending on what the signals they get from the market. Then who does these changes? This is done by your fund manager. We will come to that point that who is your fund manager or what is that. The dial moves fluidly, increasing equity exposure in bullish markets and turning towards debt in uncertain or volatile times. So let's say sometimes there is a bullish market in our share market on Indian market, then they would increase their exposure in equity segment. And sometimes when there is a bearish market or the volatile market, let's say from the last 1 year, it is a volatile market and it is bearish market. Now there would be asset allocation in debt. This constant adjustment can help you keep your investment journey smoother and in tune with changing market conditions. So what happens when you invest in this fund? So this constant adjustment helps you to keep your investment journey smoother and it gives a tune to this changing market conditions. The usual question, where are we in this cycle, downturn or recovery? So these questions we have in our mind. So we are not always aware of the answer. Growth outlook, early upswing or late expansion, investor sentiment, are we fearful or are we greedy, market valuation, is it overrated or is it undervalued? We need to understand these things. Portfolio strategy, style, sector, market cap, acquired duration. Everything is taken care by the fund manager. Now let's say asset allocation. What is the system of asset allocation? Actively managed equity and equity oriented scheme. The asset allocation is 35 to 100%. Actively managed debt and debt oriented scheme, it is from 0% to 65%, and money market only 5%, maximum 5%. So what happens is we have all these sectors in our hand. Now, what is the investment process? The objective is optimizing risk-adjusted returns. We have three things here: asset allocation, thematic exposure, and fund selection. I am advising you that if you invest in this fund, please get invested or please stay invested till 3 years or more. Now, step one is asset allocation. So we need to first, or the fund manager needs to first consider about the valuation. Shiller earnings yield minus bond yield, trailing earnings yield minus bond yield. Earnings model based on macro indicators and sentiment, multiple parameters such as breadth of the market, retail participation, etc. And these all brings down to potential equity returns. Asset allocation framework, a counter-cyclical approach to investing. So let's say what is the asset allocation? You could see here Nifty gave you a good returns, and here the asset allocation was something in the orange color. These are all the frameworks that what the fund manager checks before investing in any stocks or something. Now, investing through cycles. So if you see the year 2014 to 2016, it was a recovery period, and their style was value based, and market cap was broader, and they invested in cyclical sectors. In 2005 to 2007, it was an expansion market. The style was growth and momentum. Market capitalization was broader market, and sectors were cyclical. Now, if you see when there is a slowdown in the market, like 2008 to 2013, the style was mixed. Market cap was large, and sectors were defensive sectors. And when there is a downturn, so now in the case of downturn, you need to move towards quality style, quality sector. Market cap should be large, and sectors defensive sectors. Now here we see the rolling returns, better risk-adjusted returns in long term. So here you see, sometimes when there is a maximum return, Nifty gives you good returns. But when there is a minimum chances of return, then you see that hybrid index never gave you negative returns. Never. Nifty gave you negative returns. So that is the use of this dynamic asset allocation, or whatever we say, hybrid fund, with lower drawdowns. When there is drawdown in the market, then you see Nifty draws down very quickly. But in case of hybrid funds, there is a less drawdown. Diversified allocation demonstrates resilience in market downturns and can recover faster than pure equity allocation. Get the advantage of fan approach. So what is the fan approach? So let's see what is the fan approach. Flexible. The fund has the flexibility to dynamically shift its exposure across asset classes, that is equity, debt, and investment styles and market caps based on evolving market conditions. So it depends on the market conditions in which sector or in which asset the fund wants to invest. Agile. The investment process of the fund uses macroeconomic and market data to determine the change in portfolio allocation. So what happens is it uses macroeconomic and market data to determine that what should be the change in portfolio allocation. And nimble. One of the most important aspects of fund is its ability to shift allocation in a timely manner without investors' intervention. The investment framework of the fund will be rebalanced on monthly basis. So there is no need for investor intervention. Everything is done automatically, and the fund is rebalanced in a monthly basis. The fan approach can result in better tax efficiency compared to a DIY asset allocation strategy, as movement between funds in DIY approach may trigger tax events. In contrast, investors in the fund will be subject to long-term capital gains tax of 12.5% after 2 years of investments. So you see, if we do the asset allocation by ourselves, do it yourself, then there could be some events of tax. But if we do it through mutual funds, so mutual funds is a trust, so there is no chances of tax when there is a movement of, or when there is an asset allocation strategy done there. You only need to give like 12.5% taxes after 2 years of investments, or whenever you take it out, or whenever you sell your funds. Why choose SBI Dynamic Asset Allocation Active Fund of Funds? Aim to choose the best of both worlds. We want to get good returns from both sides, from equity also and from debt also. Tried, tested, and evidenced formula for asset class navigation. It is a tried and tested method, and it has evidence that it gives you good returns. need to add a layer of nimbleness and agility. We want that our funds should be balanced automatically. We don't want to do it by ourselves. And multiple funds dedicated to diverse strategies and granular approach to derive potential returns. And there are multiple funds inside this fund. So it gives you a granular approach and gives you good potential returns. And now we get to see some facts about these funds. The name of the fund is SBI Dynamic Asset Allocation Active Fund of Funds. It is a open-ended fund scheme investing units in actively managed equity and debt-oriented mutual fund schemes. So what is the objective of this scheme, or why was this scheme or why was this fund started? The investment objective of the scheme shall be to generate long-term capital appreciation by investing in actively managed equity-oriented and actively managed debt-oriented mutual fund schemes. However, there is no assurance or guarantee that the investment objective of the scheme would be achieved. So it invests in actively managed debt mutual funds and actively managed equity mutual funds to give you good returns, but there is no assurance or guarantee. So see, in mutual fund there is no guarantee because it is a business. It is not, let's say, debt funds, or let's say it is not something which gives you regular interest. It's a business. There could be gains, there could be loss, and it depends on the market. NFO dates. So when could you invest in this new fund offering? It starts from 25th August. It has already started. And it goes on till 8th of September 2025. So who are the fund managers? For the equity portion, the fund manager is Mrs. Nidhi Chawla, and for the debt portion, it is Mr. Ardhantu Bhattacharya. So which plans are we having in this? We have direct and regular plans with growth, income distribution, capital withdrawal, or we could say dividend funds, dividend payout, and transfer and reinvestment option. What is the minimum investment amount in this? So minimum investment is 5,000 rupees, and in multiples of rupees 1 thereafter. So 5,000 and more. And if we tell about the additional purchases, rupees 1,000 or more. Let's see what is the exit load here. For exit load, for units purchased or switched in from another scheme to funds are redeemed or switched out on or before 12 months from the date of allotment, up to 25% of the investments nil. For remaining investment, 1% of applicable NAV. So if you sell your units before 1 year, so up to 25%, there will be no taxes, and after the 25%, let's say the next 75%, there will be a tax of 1% of the applicable NAV. Up to 12 months, no taxes or no exit load. And the next thing or the last thing is mutual fund investments are subject to market risks. Read all the investment documents carefully before investing. So if you want to invest in this dynamic asset allocation fund of funds, this new fund offering, you could contact me. I will give you my mobile number as well as the email ID in the description box. You could contact me there. I am a AMFI registered mutual fund distributor as well as an insurance advisor. So whatever topics or whatever things you need some advisory, please contact in the given number and the email ID. So this was all for today's video. Signing off. This is MD Jala. Thank you for watching this video.